Hi everyone, this is Alan Rosinski, Principal Broker of Metro Manhattan Office Space. Good afternoon. In light of some recent high-profile deals involving co-working space companies IWG and WeWork, I wanted to explain the significance of those deals and discuss what they mean for the future of co-working office space in New York City. Co-working space refers to full-service, pre-built workspaces that companies and individuals can rent on a short-term basis. Co-working spaces can offer anything from a single desk to an entire floor. This business model enjoyed years of uninterrupted growth in Manhattan, powered by startups, freelancers, and established companies looking for extra desks. But by the end of 2019, the sector began to stall. All over the city, shared space players like WeWork and Regus defaulted on their commercial leases. Uncertainty brought about by COVID-19 in 2020 seemed like it might kill the co-working industry altogether. However, it seems that the last few weeks have demonstrated that this business model is here to stay. As companies reassess their office needs, co-working space could fill a crucial gap in commercial leasing. This month, International Workplace Group, or IWG, which you may know as Regus, inked a deal with AEW Capital Management for 58,000 square feet at 250 Park Avenue. This follows closely on the heels of IWG adding 91,000 square feet at 401 Park Avenue South and 14 Penn Plaza to their portfolio of co-working office space. This is significant because less than a year ago, IWG closed 1/5 of its New York City office spaces. It reported 620 million British pounds in losses in March of 2021. Yet in the second quarter of 2021, it looks like IWG is making a comeback. WeWork is another company that seemed finished even before the pandemic. It has also seen its fortunes improve. In late August, WeWork landed a $70 million federal contract to accommodate government workers on demand for the following year. The feds also have an option to renew this contract for an additional 4 years. WeWork is the largest, most visible, and perhaps the most controversial company in the shared office game. I've written extensively about their ups and downs in recent years. At the end of 2019, they were facing a failed IPO and a messy buyout from SoftBank that forced the resignation of their founder, Adam Neumann. Under the leadership of the current CEO, Sandeep Mithrani, WeWork has cut overhead, trimmed staff, and vacated underperforming spaces. The result is a leaner company with a more realistic valuation. Right now, they seem to be on the upswing. Only 2 years after the SoftBank debacle, WeWork has entered an agreement to form a strategic partnership with Cushman & Wakefield, one of the world's largest commercial real estate services firms. Unfortunately, the COVID resilience we see in WeWork and IWG is not uniform across the shared office industry. Perhaps the most prominent casualty in the industry was the boutique brand Knotel. In 2016, Virgin co-founder Amol Sarva and venture capital investor Edward Shendarovic started the company. By 2019, it had achieved a valuation of $1.6 billion and leased 2.5 million square feet of New York City office space. The bottom dropped out for Knotel with COVID-19. In March of 2020, it reduced its staff to only 200 employees. Knotel ended 2020 frantically working to raise $100 million that never materialized. In February of this year, the company filed for bankruptcy. It was eventually sold to its investor Newmark for $70 million. I wanted to stress that Knotel suffered from systemic issues long before COVID. Its focus on expensive build-outs and long-term commercial leases quickly led to financial overextensions. As early as 2019, news reports circulated about a $233 million shortfall for the company. Knotel was uniquely positioned to fail in a nationwide office shutdown. Other New York City shared office operators have weathered the storm well. Industrious, a co-working company founded in 2012 that manages about a dozen locations in New York City, reported its all-time highest weekly earnings at the end of July 2020. While Servcorp, an Australian-based firm, has cut its U.S. footprint in half last year while still managing to post a modest profit by year-end. The co-working office model seems to be thriving in the post-pandemic rental environment, which may be surprising to some people. In my view, the reasons are twofold: workplace uncertainty and workplace evolution. We have seen many companies try to establish plans for full returns to the office only to push them back. Most recently, the Delta variant has dashed countless return-to-work timelines. Co-working offices offer a flexible, short-term option for these companies. Furthermore, a year and a half of remote work seems to have forced an evolution in white-collar work. The stigma against working from home has faded. American employees are less interested in returning to a 5-day-a-week commuter lifestyle. At the same time, workers can't stay at home forever. Isolation, family issues, and the limitations of remote communications make it inevitable that a portion of the workplace will have to return to the office. Still, it won't be the same kind of office that we left. For as long as the future remains uncertain, substituting short-term desk rentals might be the new paradigm. Larger companies like IWG, WeWork, and Industrious can provide workers with a la carte desks in satellite spaces close to their home. Traditional landlords have seen the potential of co-working offices and are getting into the game. SL Green, APF Properties, and Silverstein Properties all have co-working businesses. These businesses enable them to provide breakout space for existing tenants. They also create profitable startup lease opportunities. Now, how long will the co-working industry remain on the rise? And what will happen once the effects of the pandemic recede and more people return to their company offices? I think that we are seeing a rare second chance for a promising but flawed business model. If co-working is to succeed long-term, operators must contain their leasing, staffing, and overhead costs. A business model based on constant expansion and budget-breaking amenities just isn't sustainable. Co-working offices will also need to think beyond their core customers. They cannot market only to startups and individual entrepreneurs. In a way, the pandemic has made every company a viable shared space tenant. A right-sized, scalable co-working model has tremendous upsides. Companies are trying to reinvent their office space strategy, and workers want a balanced ratio of working at home and working at the office. This creates business opportunities for co-working companies to reinvent themselves and hopefully arrive at sustainable, long-term business models which offer good value to larger companies and small entrepreneurial New Yorkers as well. I'd like to hear what you think about co-working office space and whether you believe the pandemic will ultimately help or hinder the co-working business model. I hope that you found this video informative. Thanks for watching and stay well. If you found this content interesting or helpful, I'd be happy if you subscribe to my YouTube channel. You can always find me on Twitter. My Twitter handle is @MetroManhattan. Until the next time.